Assalamualaikum warahmatullahi wabarakatuh. Hello guys, how are you? I hope you guys have a good day. In this occasion, we will present about the finance presentation credit assessment. But first, let us introduce ourselves. My name is Muhammad Miftahul Akyal with name 0995 and my partner.
Anisa with name 098.
And let's check out to the material itself. This is the table of content. The material will be separated by 6 points. The first point will be introduction. The second one will be credit assessment. The third is credit analysis process. The fourth will be assessment tools and methods. The fifth is credit risk and mitigation. And the last one is regulators and credit data. This material will be presented by my partner for Anisa 3. Time is yours.
Thank you for the opportunity, Miftah. So here I will introduction the definition of credit, what is credit itself. So based on Undang-Undang Republik Indonesia Nomor 10 year 1998 about the changes of Undang-Undang Republik Indonesia Number 7 year 1992 about banking. Credit is the provision of money or bills that can be accumulated. So based on a loan agreement or agreement between a bank and another party that requires the borrower to repay the debt after a certain period of time with interest. So that's the explanation based on Undang-Undang Republik Indonesia. And based on Tasmir, credit is a trust. It means the trust of the bank or creditor in the customer or creditor. Where the bank believes that the customer will definitely repay the loan according to the agreement that has been made. Thanks, Miftah. Okay, next is purpose of credit. Here are few general objectives. The first is profit function. It's increasing revenue. So the profit function of credit involves extending funds to borrowers with the bank to earn income regularly through the collection of interest and various fees, thereby increasing the institution's overall revenue and profitability. Second is development function. There is promoting economic development. Sorry. So the development function utilizes credit as a catalyst for growth by financing productive activities such as infrastructure, project or new business ventures, which ultimately stimulates job creation and boosts investment and promote economic development. Third, we have liquidity function that is helping the public obtain funds for urgent needs. So the liquidity function serves as a vital financial resource, enabling the public to quickly obtain necessary funds to cover immediately or urgent needs, like for example, unexpected expenses or bridging short-term financial gaps, and thus providing financial flexibility and stability. The last is distribution function. Income distribution through the development of small business or MSMEs or in Indonesia it's UMKM. The distribution function facilitates a more equitable allocation of wealth by channeling credit, often in the form of loans to small and medium-sized enterprises. And this support helps develop this business, generating income and contribute to a better distribution of income across the community. Okay, you can next slide, Miftah. Next is types of credit. We'll classify types of credit by something. The first is by purpose. There is productive credit. Productive credit used to increase income, purchase asset, or expand a business. The loan is a direct revenue to repay. So example, working capital loan, investment loan for new machinery or factory inspection. So basically, this extended to business or to increase income or purchase assets where the loan directly generates the revenue needed for payment. So second, we have consumptive credit. This used for personal needs or consumption that does not generate income. For example, credit card, debt, personal loan for vacation, and auto loan for like personal car. So consumptive credit is used for personal needs or consumption, such as vacation, car purchase, and does not generate income. The last it is specific it we have investment credit, specifically for long-term capital expenditures such as like building a new facility, buying new equipment, or developing a project. Like for example, is mortgage or home loan and loan for large-scale construction. So it's designed for long-term capital expenditures, something like that. Next question. Okay, next is classification by term or maturity. These are three types. The first is short-term credit. This refers to loan that has a repayment period of up to 1 year. Next is medium-term credit. These loans generally have a repayment period ranging from 1 to 3 years or sometimes up to 5 years. And the last is long-term credit. The specification covers credit with a repayment term more than 3 or 5 years, such as like mortgage with terms of 10 to 30 years. Okay, next. Next is the other common classification by collateral or security. Secured credit requires collateral like house or car, and unsecured credit or no collateral required, like for example, credit cards, personal loans. Also, second is by repayment structure. Installment credit, fixed payment over a set time, for example, like car loans, and revolving credit, like a line of credit that can be used repeatedly up to a limit, like for example, the credit cards. Next, Eva. Okay, this is credit assessment. There are five credit assessment in here. I will explain. The first is the character. It refers to the borrower's integrity, trustworthiness, and willingness to repay the debt. And lenders examine credit history, repayment track record, and preferences. Second is capacity. Is the borrower's ability to repay the loan based on their current cash flow and income. Lenders assess their debt to income ratio and financing obligations. Also, third is capital. It here refers to the borrower's net worth or the amount of money they have invested in the business asset they are seeking a loan for. And it shows the borrower's personal stake in the venture, indicating their risk exposure. Also, number four is collateral. It refers to assets pledged to secure the loan. If the borrower defaults, the lender can seize and sell the collateral to recover the loss. And the last C is condition. Assess the economic environment and specific terms of the loan. These include factors like purpose of the loan, interest rates and industry trends, and the general state of the economy. Okay, next, Miftah. Okay, this part will be presented with the
Okay. Okay, thank you so much for the opportunity. And let's move to the credit analysis process material. Okay, before you guys want to apply a credit submission to something, you have to prepare some things. Okay, first, we have to credit application submission. The applicant or we will submit a credit application or opening to the relevant bank by attaching several documents in accordance with the applicable requirement, such as KTP, company legality, kartu keluarga, salary slip, nomor pokok wajib pajak atau NPWP, and nomor induk perusahaan atau M.AB, and photocopy of the certificate used as collateral. If you guys want to submission a credit, you can see on the picture. It's some example if you want to submission a credit on the bank. Okay, the second step is credit file research. The bank will conduct a thorough and detailed review of the submitted credit application. Generally, bank will use a number of methods to analyze the credit application, such as the 5C principles in the previous slide. And if the application is complete and meets the requirement, the bank will proceed the next stage, which is the credit worthiness assessment. But if the application is incomplete and does not meet the specific requirements, the bank will ask the applicant to complete it first. The next step is initial interviews. The initial interviews is a face-to-face investigation of a prospective customer. The goal is to convince the bank that the documents are accurate and complete as requested. This interview is also claimed to determine the customer's true desires and needs. And my suggestion is to keep this interview as relaxed as possible, hopefully resulting in the borrower speaking more effectively and gaining more information from the bank. The next is on the spot. It's not a reality show, but it's on the spot. Field inspection involves inspecting various objects that will be used as business or collateral. The result of this observation will be compared to the initial interview. During on-the-spot inspection, information should be disclosed to the customer. This ensures that what is observed in the field reflects the actual situation. The next one is second interview. This step is a document revision activity where any deficiency may have been identified after the on-site field work. The next one is credit application decision. A credit decision is the final decision of the bank's internal team to determine whether the loan will be granted or rejected. If approved, the administrative details are prepared. So typically, the credit decision that will be announced included amounts received, the loan term, the fees to be paid, the loan disbursement time, and other provisions. The next one is credit application approval. Credit application approval is the bank decision to grant part of all prospective customer credit application. To protect the bank interest in implementing this approval, the terms and the condition of the credit facility and the procedures the customer must follow the usually outlined in advance. The next one is credit realization. Credit realization is granted after signing the credit agreement and completing the necessary document by opening a checking or saving account at the relevant bank. For example, you can see the picture behind this text. It's an example of the credit agreement itself. And the last one is fund disbursement or withdrawal. Fund disbursement or withdrawal is the disbursement or withdrawal of funds from the account as the realization of the loan. This can be withdrawn according to the terms and conditions of the loan, either all at once or income itself. The next one is assessment tools and methods. There are several assessment tools and methods in making a credit on the bank itself, guys. Okay, the first tool is we going to use liquidity ratio or ratio quali liquiditas. This ratio is to assess the debtor ability to meet short-term application debts that are due soon, because liquidity indicates that the debtor's short-term ability to pay obligation, including monthly in credit installment. There are two types of liquidity ratio. First, the current ratio. The current ratio, also known as the working capital ratio, measures a business ability to its short-term obligations that are due within a year. This ratio compares a current assets to total current liabilities. And also, by this ratio, there is a calculated formula for this ratio. You can see on the formula itself. Next, we will talk about the quick ratio. The quick ratio, also known as the acid test ratio, measures the ability of the business to pay its short-term liabilities. But unlike the current ratio, the quick ratio limits assets to cash or other assets that a company can swiftly convert into cash. The quick ratio itself is usually calculated by subtracting inventory from the total current assets and dividing the result by total current liabilities. For example, there is the formula. The next assessment tools or methods is a solvency ratio or atau rasio solvabilitas. This ratio is a financial ratio that measures a company's ability to meet its long-term financial obligation. This ratio indicates whether a company has sufficient financial strength to maintain business continuity. There are two types of this ratio. First is DAR or debt to asset ratio. This ratio is one of the most basic solvency ratios, indicating how much of a company assets are financed by them. the formula as you can see. The next one is DAR, which is debt to equity ratio. It's a ratio that compares total debt to shareholder equity to assess the extent to which a company relies on debt versus equity. And the formula, as you can see. The next one is profitability ratio atau rasio probabilitas. Is a ratio or a comparison to determine a company ability to earn profit from incomes or earnings related to sales, assets, and equity based on a certain measures basis. The first ratio is ROA, which is return on assets. It's all about how well a company used its assets, being buildings, equipment, cash, and even actually property to generate profit itself. For the formula, as you can see. The next one is ROA, which is return on equity. On the other hand, focus on the return shareholders are getting from their investment in the company. It's all about how well the company used the money its owners have put in. As you can see, the formula. The next one and the last one is credit scoring or credit assessment. It's a system implementing by financing institutions such as bank, fintech, P2P lending, or other lending parties to assess the risk profile of a borrower regarding their eligibility for funding or not. As you can see, there are several scores which can be described by the specific terms, as you can see, guys. Okay, the next one will be presented by my partner.
Okay, thank you for the opportunity. In this section, I will talk about the risk and mitigation about credit in Indonesia itself. So, credit risk in Indonesia is generally defined as the risk of loss due to a borrower's failure to meet their contractual obligations. So, here are the key drivers of credit risk. The first is high concentration in MSMEs or micro, small, medium enterprises. A significant portion of lending is concentrated in MSMEs, which, while crucial for the economy, might face a greater vulnerability to economic fluctuation and this posing a higher portfolio risk for financial institutions. Second is economic volatility and global uncertainty. The nation's financial stability can be impacted by domestic economic volatility and broader global uncertainty such as commodities price swings or geopolitical events, which can negatively affect borrowers' repayment capacity. So the third is digitalization and fintech lending. The rapid growth of digitalization and fintech lending introduces new risk dimensions, including operational risk, cybersecurity threats, and the challenge of assessing credit worthiness for borrowers without traditional collateral. Also, last is the fourth is climate-related risk. Climate-related risks is like for example, extreme weather events, changing regulation. This can impact sector like agriculture or insurance, potentially leading to financial losses that impair the ability of affected borrowers to serve their debts. Also, how's the mitigation strategy? Financial institutions in Indonesia basically employ a range of strategies mandated or encouraged by OJK to mitigate credit risk. These are some points. The first is enhanced credit assessment and policy. A bank utilizes more sophisticated methods and strengthen policies to truthfully evaluate a borrower's creditworthiness, like the 5CS model. Like I mentioned it before, the character, capacity, capital, collateral, and condition before approving loans. Second is collateral and guarantee. Institutions often require collateral like assets like property or vehicles and guarantees from third parties to secure the loan, providing a secondary source of repayment in case of default. Also, third is portfolio management. This strategy involves actively managing the bank total loan portfolio by diversifying exposures across different sectors, regions, and borrower types to reduce concentration risk. Also, next, the last one is regulatory oversight and governance or OJK mandates. Strict regulatory oversights and compliance with mandates from the OJK ensure sound banking practice, strong governance framework, and adequate capital reserve to absorb unexpected losses like that. Okay, you can next slide, Miftah. Regulator and credit data in Indonesia itself, we have a few regulators. The first is from Otoritas Jasa Keuangan or OJK. The function is control area of prudential regulation, licensing and supervision, credit information system or CLIK, and consumer protection. Also next is SLIK atau sistem layanan informasi keuangan. A centralized system for credit data managed by OJK. It is the successor to the previous Auditor Sector Information System or S.ID, formerly managed by Bank Indonesia. So next is credit data. There is credit bureaus or M.AB. They are private institution licensed and supervised by the OJK to collect, process, and provide credit information and risk management solutions. And they often complement the SLIK data or SLIK by offering advanced analytic credit score and sometimes alternative data sources to help lenders to make nuanced credit decisions. So next is from Bank Indonesia, or we call it BI. Here, BI implements policies to manage systemic risk in the economy, which indirectly affects credit risk. Like for example, BI regulates loan to value or LTV ratios for property and down payment rules for vehicles loans to prevent overheating in the sector and control debt level. I think you can let's with that. Okay, this study case will be held by my partner. Time is yours.
Okay, thank you for the opportunity. And this is the study case material. So if you guys want to know where the source that we use, if you can scan the QR code here. And let me tell you about the study case itself. Global economic pressure resulting from geopolitical conflicts and international trade tension have not prevent national banks from maintaining the quality of credit assessment, particularly for the MSME sector. Banks have responded to this situation by implementing more selective growth strategies and strengthening risk management through prudent principles and the use of various monitoring tools such as early warning system, credit scoring, credit ratings, and fraud detection system. This effort has been accompanied by increased human resource capacity and strength technological infrastructure to make the credit assessment process more accurate and adaptive to market change. As a result, risk indicators such as non-performing loans and loan at risk have shown significant improvement, indicating an increase in the quality of the financing portfolio. Risk management strain measures have also been implemented more specifically by sector and region, allowing for more precise credit decision despite ongoing global uncertainty. Several national banks have maintained positive performance, demonstrating that their implemented risk mitigation strategies have successfully maintained stability while still providing room for MSA growth. The government still continues to encourage synergy between the financial sector and business actors to ensure more adaptive, resilient, and highly competitive business climate in the Indonesia itself. And that's for the study case. And this will be the last material from us. Will be word is thank you so much for watching this video from beginning to the end. I hope you guys can learn something from this video. Me and my partner will say thank you so much for watching this video. Bye bye.